Welcome to the latest in Fitch's series of global virtual investor meetings. We have one-on-one meetings with hundreds of investors each year and want to give you a glimpse inside these meetings. I'm Rui Pereira and I head up Fitch's North American Structured Finance team here in New York. I'm thrilled to be here today with Huxley Somerville, who heads our U.S. Commercial Mortgage Group. Welcome, Huxley.
Thank you.
Huxley, I want to start off by talking about where we are in the commercial mortgage credit cycle and credit enhancement available to investors. So where are we in the cycle, and do you still think credit enhancement is appropriate relative to the prevalence of IO loans that we're seeing in transactions, where property values are, and the backup in interest rates that we're starting to see?
Well, believe it or not, we're about to start the 10th year of the current real estate cycle. May 2009 was the nadir of commercial real estate valuations, and since then it's been a slow but steady increase. So we are, given historical norms, quite late in the cycle. However, the way I look at it almost is like dog years, that the current cycle is really worth 2 years of the old cycle. So maybe in that case we're only at year 5, because we're certainly not seeing what you would expect to see this late in a cycle. Construction has been relatively benign. There are pockets of construction that we watch carefully, but overall at the aggregate, construction levels are fairly muted and certainly take place in areas where their demographics or the business activity demands it. Interest rates are rising. When we model CMBS, we have stress rate interest rates anyway that started around 8%. So right now in current conduits in 2018, the average mortgage rate is still sub 5%. For interest only, that's a concern that we have been vocal on for several years now. Since 2011, interest-only loans as a proportion of total loans is 3 times what it was in 2011. And certainly refinance risk is the biggest concern, and a very low interest rate environment that these loans have been originated in, one would only expect that the interest rate environment will be higher when they do come to refinance, and any benefit from amortization that could have been inherent in those loans is lacking because of the IO nature. The one area where we do see what we would expect to see this late in the cycle is the increasing haircut to issuers' cash flow. That has increased, it's almost double what it was in 2011, and that's driven mainly because of assumptions on vacancy, where an originator may think that 5 years of high occupancy is going to be sustained throughout the next 10 years. We don't agree with that, and that's where we see haircuts increasing.
Great, thank you. I want to follow up on something you said. One of the things that you mentioned is that we're 10 years into the cycle. So 10 years in, what trends are we seeing in underwriting?
Well, believe it or not, we're actually seeing an improvement in underwriting over the last 2 years. 2015 was the worst year from a Fitch LTV and a Fitch DSCR, debt service coverage ratio aspect. Since then, they've slowly improved, and credit enhancement has actually reduced because of that.
I'm sure an area of focus today is on property prices or valuations. So when you look at the portfolio, what subsectors or regions are you most concerned about today?
Valuations we're less concerned about. When we look at a property, we use our own cash cap rate, which started around 8%. So if a property's been valued on a 4% cap rate, when we use an 8%, we're automatically cutting the implied value in half. That's not to say that there aren't pockets of concern where we are carefully watching. We have what we call quarterly assumption meetings, which look at long-term trends in vacancy and occupancy, tenant improvements, concessions, demographics, etc. And that meeting has thrown off 2 changes that we've taken over the last couple of years. One on hotels, where we start with 2014 revenues, no higher than 2014 revenues, unless there's a good case to come off that. And the second aspect has been multifamily, where our starting point is 2016 revenues. We believe that for the next couple of years, the revenues probably will be at the levels that they've seen post 2016, but we don't believe that they will be there the full 10-year cycle.
One of the sectors that you didn't mention is retail. It's had some issues in terms of ratings performance, and I think as a result of that, we've seen fewer of those loans being contributed to conduit transactions in recent years. What do you think about that trend, and what's replacing those loans and transactions that we're seeing today?
So you're right. Retail has been a concern of ours since at least 2014. I think also a concern for investors. Retail is going under a fundamental shift, and while we believe retail will be around in the future, certainly Class B malls we're very wary of, especially if it's a Class B mall competing against another Class B mall in the same area. One probably will survive, but which one, it's difficult to say at this stage. So we see a bogey of, say, 25% in conduits. Below that level, you see a lot of transactions with 20–24% retail. Above that, I think it's very easy for investors to say they're not interested in that transaction. But the problem is that when you reduce retail, and it's come down 10 percentage points since previous years, it's replaced with something else, or at least the proportion of the deal that other property types make up is increased. And we have seen an increase in hotels, and hotels by their very nature have very volatile income potential. We've also seen an increase in suburban office, especially single tenant suburban office. And again, I think you have to be very careful what replaces retail, because both those two property types, we believe, could be worse than a retail property of the same quality.
So we're 10 years into the cycle, and when you look forward over the next 24 months, what do you view as the biggest challenges to CMBS performance? Is it a function of the interest rate path? Is it political risks? Is it maybe technology risks similar to what we've seen in retail? What are your views?
So if we look at what we know now, interest rates are rising. We believe they'll continue to rise, though steadily. We're also entering the first CMBS 2.0 refinancings. So if interest rates rise a little more substantially than we expect, that could impact the ability of those loans to refinance. So that's probably the one risk that we see right now as possible to occur. I think the bigger concern, though, is probably something out of left field that affects the capital markets and the macroeconomic environment more fundamentally. For instance, just looking now at what's happening in Italy, how does that impact what we see in the next 6 to 12 months?
Excellent. Thank you very much for sharing your perspective, Huxley.
Thank you.
Next up in our series will be virtual meetings with our global colleagues, so watch this space for new content. If you have any questions related to any of the topics that we covered, please send an email to the address on the screen. Thank you all for watching.